You did everything right. You took the steady job, maxed out your 401k every year, paid extra on the 30-year mortgage, skipped the fancy vacations so your kids could have braces and college funds. You played by the rules. So why does it still feel like you're falling behind? And more importantly, why does no one explain this clearly? Your paycheck doesn't quite stretch as far at the grocery store. Health insurance premiums keep climbing. And when you open your retirement account, the balance just isn't growing the way the financial planners promised it would back in 2015. You're not alone. Right now in 2026, the U.S. national debt has climbed past $38 trillion, while global debt just hit a record $348 trillion, according to the Institute of International Finance. These aren't abstract numbers. They create real structural pressures on everyday middle-class households like yours. Let me introduce you to Mark and Lisa, a couple I've met in many forms over the years. Mid-40s, suburban Midwest, combined household income around $145,000, 2 kids in high school, solid 401ks, an IRA for Lisa, and a 30-year mortgage they locked in a few years ago at about 6.8%. On paper, they're winning. But groceries are up sharply, property taxes rose again, and their health insurance deductible jumped 18% last year. Their retirement projections? Flat. The same portfolio that was supposed to hit $1.2 million by 65 is now barely keeping pace with real living costs. This is the quiet tension millions of American families feel every month. It doesn't feel like a crisis. It feels like math that just won't cooperate. Last Tuesday night, Mark and Lisa sat at their kitchen table going over college estimates for their daughter. The numbers had climbed another $12,000 since last year. Lisa looked up and asked quietly, "Are we still on track?" Mark didn't answer right away. Instead, he pulled out his phone and opened the 401k app. After a volatile week in the markets, the balance had dipped a few $1,000s. Nothing catastrophic, just enough to make him pause. They checked the latest Social Security projections, too. The trustees' report shows future benefits may need adjustments because of the same long-term pressures we're talking about today. It wasn't panic in their voices. It was that steady, middle-class concern so many of you recognize. The sense that the plan you built is working harder than it used to, yet delivering a little less. To understand what's happening today, we have to look back at how debt cycles have played out for the past century. Modern economies have relied on expanding credit to fuel growth. The 1920s saw easy credit fuel a boom. When it reversed in 1929, the contraction was severe. Families lost savings and homes. By 1971, the U.S. moved away from the gold standard. That shift gave policymakers more flexibility to manage the economy through credit and spending. It also changed how savings held value over time. 2008 brought another major cycle. Banks faced stress. The government and Federal Reserve stepped in with extraordinary measures. Middle-class homeowners felt the pain first and longest. For many families, retirement plans were delayed by years. Then 2020, a global shock met with the largest fiscal and monetary response in history. Debt levels surged. For the past 40 years, we've watched U.S. debt to GDP rise steadily. Each cycle has left the system a little more leveraged than before. Now, in 2026, with U.S. debt over $38 trillion and global debt at $348 trillion, we're seeing the next chapter of that same historical pattern. But what makes this cycle different from 2008 isn't just the size of the debt, it's who ends up absorbing the pressure. And that's where retirement accounts quietly come into the story. In 2008, the pressure was immediate and visible. You saw the housing crash on the evening news, layoffs at factories, and neighbors putting for sale signs in their yards. The crisis had a face. In 2026, the pressure is different. It's gradual, persistent federal deficits, higher Treasury yields that affect everything from mortgages to corporate borrowing, and slower real returns that compound quietly year after year. There are no mass layoffs on the nightly news, no single dramatic event. It's a slow compression rather than an acute shock. And that slow compression is harder to notice, but just as powerful. Picture this. You're 58, 5 years from retirement. You log into your 401k portal on a quiet Sunday evening. The number you see is respectable, but when you run the retirement calculator, it tells you your projected income in today's dollars is lower than it was 3 years ago. Health insurance premiums for retirees keep rising faster than Social Security adjustments. The latest COLA helps, but Medicare premiums have climbed again this year, taking a bigger bite. When interest rates rise, new savers get better yields, but older bonds inside your retirement account lose value. That's why some safe funds haven't felt very safe. And that realization lands heavier than any market headline. Mark and Lisa ran these numbers last month. Their projected retirement income gap widened by about $800 a month in real terms. If inflation averages 4% and your portfolio grows 5%, your real gain is just 1%. Not because of one bad investment, but because the environment around your savings has changed. This is how large-scale debt affects everyday Americans. Gradually, through higher costs, slower wage growth relative to assets, and different returns on the savings you worked so hard to build. The pressure appears in four quiet places most families feel every month. First, mortgage rates. Even a 1-point increase on a 30-year loan adds hundreds of dollars to monthly payments for anyone refinancing or buying now. Second, property taxes. Local budgets strained by higher borrowing costs have pushed assessments higher in many suburbs. Third, insurance. Homeowners and health insurance premiums continue their steady climb, outpacing wage growth for many households. Fourth, bond volatility inside retirement accounts. When Treasury yields move, the value of existing bond funds can drop, even while new bonds offer better rates. None of these feel like a single crisis. Together, they create a different kind of math. To be clear, debt itself isn't evil. Economies require credit to grow businesses, buy homes, and fund innovation. The issue isn't debt, it's scale. When total debt reaches these historic levels, the system naturally adjusts, sometimes through modest inflation, sometimes through higher interest costs, sometimes through slower real returns for savers. Historically, heavy debt cycles resolve through a combination of economic growth, policy choices, and time. Understanding this pattern doesn't mean panic, it means perspective. So what does this mean for Mark and Lisa, and for you? The greatest risk isn't market volatility, it's assuming the environment hasn't changed. Families who understand these cycles early don't just survive them, they position themselves to grow through them. They reassess their asset mix with the understanding that cycles change and portfolios must adapt. They build in more flexibility and liquidity so they're not locked in to yesterday's assumptions. They avoid overconcentration and focus on real returns, not just the nominal numbers on a statement. Most importantly, they stop treating yesterday's plan as tomorrow's guarantee. History shows us that every major debt cycle eventually finds its balance. The families who thrive are the ones who see the shift early and adjust thoughtfully. Most families don't fail because they're careless. They struggle because the environment shifts quietly around them. If this perspective resonated with you, I'd appreciate you hitting the like button. It helps other middle-class Americans find this kind of grounded analysis. Drop one word in the comments: perspective. I read every single one. And if you want the next chapter, a calm, step-by-step framework for positioning your 401k, IRA, and overall finances in this new environment. Subscribe and turn on notifications. This isn't about fear, it's about awareness. You've done so much right. Now it's about doing the next right thing with clearer eyes. The environment changed, not your discipline. Thank you for spending this time with me. I'll see you in the next one.